Tom Lee has done it again. He's just shocked the market with his latest analysis. And you might be wondering, Felix, why should I care about Tom Lee's analysis? Well, Lee has been known for his bullish stance on the market, and his recent observations might just change the way you approach your portfolio this election year. Picture this. The Federal Reserve makes a big juicy rate cut and the market barely bats an eye. Kind of puzzling, isn't it? But that's just the tip of the iceberg. From the curious case of investor behavior during election years to the surprising role of the tech sector in driving this market, we're going to cover all of it. And trust me, Lee's thoughts on small caps particularly are quite the roller coaster. We will also look at how I would trade Tom Lee's insight to make this the highest value video you've ever watched. You can judge me on that by the end by smashing the like or dislike button, depending on how you feel. And while we're trying to figure out what the market's up to, our teaching portfolio is up 93% already this year. We are hosting a 2-day beginner trading challenge this week. It's completely free of charge. Sign up at felixfriends.org/challenge and become part of the 1 million people we aim to make financially free. It's completely free of charge. The link's down below. But let's dive into something rather spectacular and peculiar. The Fed recently made a jumbo rate cut, and you'd expect the market to react like Winston when I mention squirrels, tries to run up trees. But Tom Lee, our market sage, put it quite succinctly about what's going on here. Since the Fed did their jumbo cut, the market really hasn't done all that much except for one day. So why this muted response? Well, there are a few potential reasons at play here. One, it seems that many investors are playing the waiting game. With the upcoming election looming on the horizon, there is a bit of a wait-and-see approach. As Lee says, a lot don't want to commit capital until after election day. And I don't think it matters who wins. It's just that they want to get that event behind them. And I actually kind of agree with them on that. Not necessarily from a political, ethical, moral, whatever kind of view, but from a pure, cold-hearted market point of view. And then secondly, there is the disconnect between market performance and the economic reality or perceptions. Lee drops this bombshell. The number of investors and professional money managers that think we're already in a recession is very high. This perception could be tempering enthusiasm about the rate cut. After all, if you think we're in a recession, you might be more cautious about jumping into the market, even at lower rates. And then lastly, we can't ignore the global economic picture. The Fed's rate cut doesn't exist in a vacuum, and as we've seen from recent reports, there are concerns about, global economic performance, especially in Europe. So there you have it. The market's muted reaction to what the Fed has just done is a factor of recession fears, global economic concerns, and just being a bit cautious on the US economy. It's like investors are playing a game of financial freeze tag. They're standing still, waiting for that magical moment when they can move again. But why? Well, elections bring uncertainty. And if there's one thing the market doesn't fancy, it's uncertainty. This wait-and-see approach isn't just about who wins the Oval Office. It's about getting clarity on future policies that could impact various sectors of the economy. And we'll see tax changes, new regulations, international trade shifts, tariffs. All that stuff is going to have a big, big impact, including tech and healthcare and energy and everything else. So what does it mean for you? Well, it suggests that we might be in for a period of relative calm before a potential storm. It's a reminder that sometimes the smartest move is to be patient and wait for the right moment. So what about that recession? Lots of people think we're in a recession. Well, the current recession perception is pretty high across the financial world. But it doesn't align with the data the government's putting out. So why does it matter? Well, perception can often drive reality in the financial world. If professional investors believe we're in a recession, they might act more cautiously, potentially leading to a self-fulfilling prophecy and that recession, no matter what data the government puts out. And don't get me started on the quality of government data. It's all, I was going to say manipulated, but that wasn't the right word. Seasonally adjusted is the official term. So what do we see when people get more cautious, when you get into that sort of recession concern territory? Well, investors shy away from growth stocks. They might move to more defensive sectors. And there might be more demand for safe haven assets. Think bonds, gold, and other traditionally more stable investments. And have a look at the gold chart and you see what the heck's going on there. But there's a twist. This pessimism could actually set the stage for positive surprises. If economic data continues to outperform these gloomy expectations and people buy it, the data that is, we might see a very, very significant shift in market sentiment. So keep an eye on these economic indicators, plenty coming up in this week and the coming week. And if you have a long-term horizon, maybe don't be afraid to go against the grain, because sometimes that's where the best opportunity lies. So what about stock prices, market valuations, and targets? What should we be doing with all of that? Well, Lee is taking a rather cautious approach suddenly. He isn't setting those high market targets. He's basically telling us to keep our feet on the ground while the market tries to touch the sky. He makes this comment: for someone to tactically say we need to pin a $6,000 target and then put money to work today, I think it's harder to make that case because valuations aren't on the cheaper end, and we've already had a fairly sizable move. So Mr. Boom, rally, go, buy to the moon is suddenly getting cautious. Why? Points out two things. Valuations aren't exactly at bargain basement prices. And secondly, we've already had a pretty significant rally this year. So how do we make money and how do we trade it? Well, I've got a chart open here on the screen, and this is in tradevision.io, which is a platform that we built. And I've got the SPY open, as in the S&P 500 ETF. And what's the green and the red? Well, we built a little indicator here based on about 15 years of my trading knowledge and then a bunch of other things that I learned on banking and so on, and the input of a couple of market makers and everything else. And while the S&P has done 19% in the last year and a half or so, we've managed to squeeze 34% out of it, which isn't bad. And by the way, we do much, much better than that on certain other stocks like Meta, Tesla, Apple, Microsoft. We actually outperform by much, much greater margins. But let's just look at the S&P here for a moment. So our indicator called a buy signal on September 12th. That looks like it was a pretty good call right now. Lee says tech is really important for the S&P to make new highs. I mean, it's 30% of the S&P 500. So let that sink in. Nearly a third of the entire S&P 500 is tech companies. And Lee goes on to say, I think tech is going to have a good year, but I don't know if it's going to be as strong as last year. So Mr. Bombastic is definitely becoming a little bit more cautious. So what do we do here? Well, diversification. While tech is crucial, you might not want to put all your money into the tech basket, because, it is also pretty volatile. And you can also look for tech exposure in non-tech sectors. Many traditional industries are becoming increasingly tech-driven. But what about Lee's most famous trade this year, the small caps? Remember, he was telling us they're going to go to the moon. Here is his take on small caps. I think that's a multi-year start for the Russell. It feels choppy, but we're still near all-time highs. And there is a big fundamental case to own small caps. And when the cheerleader for small cap says to you, be a little bit careful, well, then maybe it's time to be a little bit careful. Because, we are near all-time highs. It looks pretty good, but it could be a little bit choppy. It could be very, very choppy. And it'll get more choppy if the economy turns out to be not as strong as we think it is. And if you look at, I made a video last weekend on the GDP data that was revised upwards by $500 billion, $500 billion. What was that based on? In my opinion, it's completely made up. I don't think there is any factual basis for it. It's just a muppet inside the administration who put something in a spreadsheet and wanted to make the data look better. So I'm very, very cautious on that data right now. So what would I do right now? Well, if I'm in this position right here, I would probably wait for that breakout. I'd wait to take out the all-time highs here. Take them out, right? Go above them for at least a day, have nice volume behind that momentum, and then we're talking. So what's our verdict here on Tom Lee? Well, he's becoming cautiously optimistic. Mr. Optimism is becoming cautious, which is sensible. And I think he's a sensible guy, and I quite like that he's doing this, because it's easy to scream headlines and get, sort of clickbait, but he's actually saying, hey guys, September, October is usually pretty choppy with elections, and I've been saying this for the last 6 months. So do exactly that. And what am I doing with our trading this month? Almost nothing. Very, very, very little. And the reason is just that that is the setup. September usually is a terrible month. October before elections is usually a terrible month. By terrible, I mean very unpredictable. We don't really like unpredictable. Now, if you're a super long-term investor, doesn't really matter. Just keep buying good stocks forever and, you'll be fine. But for those of us who actually want to make money in the short term and, we're up 93% this year, why would we gamble that away on a month that doesn't have a good risk-reward setup? So there we are. If you enjoyed our little walkthrough to Tom Lee's brain, give us a what. And if you want to learn how we are up 93% this year, and I'm not promising you those returns, but I promise to be transparent with you how we do it, come and join me at felixrenzelog.com/challenge for 2 days in a row, about an hour each day. It's completely free of charge. You got to select register for both dates. You can't register for just one day. It won't let you, the software. So just select the headline, the main bold item. And then I hope to see you over there. And I wish you all the best.